Good morning. It's not fucking buddy. Welcome to the Morning Blast. It is Tuesday, the 17th of February. I'm not really quite sure how fast February's going. I can't work out, it's gone really slow, really fast. But anyway, this is the Morning Blast with myself, Ryan, and of course Michael, where we give a very candid breakdown on what's been going on in markets and what to keep an eye out for on the day ahead. Usually a bit ranty, a bit sweary. Nothing we say is trading advice, obviously. Michael, how are you?
Well, very good morning to you, Ryan. Good morning, everyone. I've just averted potentially a crisis, having hurriedly muted myself while I was discussing someone's CV at the start of the podcast. But I am fired up this morning, and we're going to give the government both barrels in about 15 minutes' time, I think.
It obviously wasn't my CV because I don't think I've ever written one.
Well, we were actually just having this conversation, and I don't remember the last time I wrote one either. It's interesting, isn't it? How you get to the point where you sort of just don't have one anymore.
just rely on your, just rely on the talk around the city.
Well, I'm not sure you should rely on that, mate, given what people say about you, but we'll leave
This
that
is
there.
very true. This is very true. This is why I had to become self-employed.
No one else would have you.
No one else would have it. But moving on, speaking about people that no one else would have, Clive Lambert from Future Tech. So let's give a quick market update from Clive over at Futures Tech's market, where market is and what levels to watch, etc. A quiet day yesterday with no US trade or China indeed to speak of. S&P is back below, or at time of print was back below 68.45 this morning. So wait and see if the dip buyers respond. DAX also posted a damp session yesterday. It's damp, or you could call it moist, and is offered overnight. FTSE futures is still eyeing resistance at 10,442. This protects the all-time high at 10,517.5. The half is all important there as someone that's 5'7.5. Bund futures trading up to resistance at 129 spot 32 to 39. Big error technically, so one to keep an eye on there. Bitcoin posted a doji yesterday, reflecting the current confused outlook. 71 to 74 is resistance. 58 to 60,000 is the big support zones lower down. They've not moved for a while. Gold and silver recovered from Thursday's selling. Brent and WTI crude didn't do too much. We're still sided with the bulls there. In WTI, 62 spot 01 is support and 63 spot 72 is first resistance. Over in the US, Henry Hub nat gas gapped down yesterday for the third Monday in a row, but we're filling that gap this morning. This side of the pond, TTF, so Dutch nat gas, so the European equivalent of Henry Hub, basically in terms of benchmark status, followed suit with a weak day yesterday. 31 spot 57.5 is gap resistance. EU carbon markets saw yet more selling, down to 68.11 yesterday, where the ship steadied in afternoon trade. So just on this, if anyone did miss this, we did cover this before, but the reason the EU carbon markets have been absolutely shafted is basically MERS is looking like deregulation and stuff in that kind of space. So all bets are off over there. German baseload power, Cal 27, posted a doji or hammer, so might attempt the rally back today, might. And that's it from Clive. Thank you very much, Clive, over at Futures Techs.
Very good. Is it me?
Yes, it's you, mate. It's you.
Oh, good stuff. Thank you, Ryan. Well, I don't really have that much to mention this morning. I mean, it was a bit of a sort of soggy and moist day for markets yesterday because, well, obviously US centres were offline for President's Day and APAC centres were offline for the Chinese New Year. So it was only us here in Europe that actually had anything to do. And I think everyone took heed of the advice that we gave on the podcast yesterday because markets really did not do much at all. Very much just treading water throughout the day, which is exactly what you would expect and hope to see on a market holiday or multiple market holidays. We have, of course, had the UK labour market stats, but we will get onto that in a moment. Give you some time to microwave your popcorn, make yourself a cup of tea and get ready for that one. Just a few other headlines worth mentioning before we do get to that, though. The first is one related to the UK, and it actually relates to the political backdrop. Of course, some of you will recall that the government had, this is actually quite a convoluted story. The long and the short of it is that there is a various reorganisation going on of how local councils are administered here in the UK. They're changing various council boundaries. Some councils are going to be expanded, some shrunk, some got rid of altogether. And this will take effect from the beginning of next year, I believe it is, or the middle of next year. As a result of those changes, the government had said that, of course, we have local elections coming up this year, but the government have turned around and said, well, actually, if these councils are being reorganised, there's probably no point in having an election to these councils. The council is serving for 1 year, and then we have to do the whole thing all over again. At least that was the narrative they gave in public. In reality, it was probably more a case of Labour are going to take an absolute pummeling in these local elections. Literally anything we can do to somewhat reduce the degree of that pummeling, we are going to try and do, which is why they cancelled a whole host of these elections. Well, with a little over 2 months to go until polling day, it's now been revealed that actually that was completely and utterly illegal. They have to hold these elections anyway. So all of the council elections that were going to be postponed are now not postponed. And according to some analysis done by The Telegraph, that means that Labour Party majorities on 10 or more local councils are now set to be wiped out as a result of the local elections that will take place on the 7th of May. It also means that the various expectations which have pointed to the Labour Party losing somewhere between 800 and 900 council seats in those polls, well, they're now going to be many orders of magnitude greater than that. So I think we were already looking at the 7th of May as the moment of kind of maximum peril in terms of Keir Starmer's leadership and his chances of seeing through his term as Prime Minister. Well, I think that's even more perilous for the government now, because the result is going to be even more disastrous than it otherwise would have been.
I think that's an important point to make, is like for those of you outside of the UK thinking, well, why is Michael going on about these small regional elections? It's basically because it's all been kind of the stars are aligning for this date to be basically the line in the sand for Starmer.
And we don't have midterm elections here in the UK. For those who are unaware, once we elect MPs to Parliament, unless there's a general election called early, they will serve the full 5 years. So I guess if you're an American listener, good morning to you, very early. But you could kind of think... Hello. You can kind of think of the council elections as something akin to the midterms. It's almost a sort of official sentiment check on the ruling party at any given time.
Exactly that. Well said. A bit of clarity there. I love it.
The other thing to bear in mind while we're talking UK politics is, of course, we do have the by-election in Gorton and Denton up near Manchester. That is due to take place on the 26th, so next Thursday. That is also going to be one worth watching very, very closely, given how the Greens and Reform are trying very, very hard to win that
and also
Labour Party.
We've also just had a new political party be announced, which is Restore Britain by Rupert Lowe, which is kind of quasi-backed by Elon Musk.
Yes, that is very true as well. So, there's a lot to digest on that front, and I'm sure we will do so in the coming weeks and months. Moving on from that, we will come back to the UK in a second, as promised. Just a couple of other headlines from yesterday, both in terms of the trade front. The first is that India and the United States are apparently trying to finalise a legal agreement on their free trade deal. Good luck with that, given that no one else has managed to do so. Apparently, India's chief trade negotiator is going to go to the US next week in order to finalise this trade pact. The reason I bring this up is because, of course, you'll recall when Trump was touting this deal 2 or 3 weeks ago, he said that India has made commitments to purchase $500 billion worth of US products. That was then watered down to an intention to purchase that much product about 2 weeks later. So do bear in mind, I suppose there's the potential for things to be watered down even more in terms of the final legal text of that. So one to keep on the radar. And also, lastly, on the trade front, actually overnight, there were some reports out of Japan that they are looking to essentially make it easier for US-made cars to be imported back into the United States. Now, this comes back to something that is a little bit mental, but we discussed earlier in the year.
I was going to
US
say,
automakers Japanese automakers are making cars in the US and then reverse importing them, basically shipping them back to Japan to be sold in their domestic market. The Japanese government are saying, well, actually, your Japanese automakers, we can somewhat simplify all of the various safety checks that we would do on a sort of run-of-the-mill ordinary imported car, basically because we trust Toyota, Nissan, Mitsubishi, etc., more than other foreign manufacturers, which makes a degree of sense.
This was Toyota were the first people to announce this back during, way back when the tariffs were hot topics, and Toyota's workaround was ship the parts over, build it over in the US, and ship it back. Yes. Make Trump happy. But yes, we live in crazy times.
Well, the other one that I did think about this morning is, I bet at some point Toyota will be running around claiming their environmentally friendly carbon green credentials at the same time as they're shipping car parts around the world three times just to cheer President Trump up. Good luck squaring that circle, lads.
Yeah, exactly. Just put a few trees down on paper or something. There you go. Offset. It's all about the carbon offset. But Michael, so that's the most of the day out of the way. But let's talk about this morning. So obviously the topic of the day is the UK labour market. The deterioration continues. So just a bit of background.
Is it deterioration or have we just fallen off fucking Beachy Head at this point?
Before I wind you up and let you go, just a bit of
like a pit bull. I'm raring to go.
Yeah, before I take the muzzle off of Michael. Well, that's a bit of alliteration. I like that.
That's very good.
A bit of background. So obviously we've had the UK employment numbers again this morning, and they've been dreadful as expected. Unemployment rate 5.2, up on the quarter, up on the year, highest since 2021. Youth employment are also worse than Europe for the first time in forever, or something like that. Payroll employees down 121,000 year on year. That's HMRC's hard data, not survey estimates as well. January 26 provisional payroll employment down 134,000 year on year, so falling to 30.3 million. So again, this is disastrous. Vacancies basically flat, but at 726,000. Employment rate is also down on the quarter at 75%. Claimant counts up. Basically, everything that's bad is going up, and anything that's good is going down. Wage picture, regular wage growth is 4.2%. Obviously, this is also kind of leaning into the public sector more so. Public sector is 7.2% disastrous, which is distorted by the base effects from pay rises being paid earlier in 2025. But basically, the trend is the fact that this isn't just a one-off bad print. This is a sustained trend now running on for months and months. At the start of 2025, unemployment was at 4%. It's now at 5.2%. This is due to Labour policies. We cannot say anything else rather than, let's not mess around with it. This is directly due to Labour policies at this rate. Michael, I've taken off the muzzle. Go.
Well, you're absolutely right. And I think we do need to go back to kind of first principles where when you look at the economy, certainly a developed market economy like the UK, ultimately everything is a policy choice, whether that be a monetary policy choice, a political choice, or a fiscal policy choice. Everything is a choice made by the leaders of the day. And the choice that the government in Westminster has made is to firstly disincentivize hiring from the employer's perspective. And they've done that in a number of ways by raising the minimum wage. I was doing some analysis yesterday. Yes, I do some real work sometimes. And the minimum wage is now 66% of the median wage here in the UK. That 20 years ago was 50%. So that wage compression is a real issue because it's becoming considerably more expensive for businesses to hire workers, particularly younger workers.
That's exactly
because the increase in minimum wage has been disproportionately high in terms of those under the age of 21 years old. Of course, that's at a time when youth unemployment is structurally heading higher as a result of things like AI and new technologies. So that creates a little bit of a perfect storm. But it's not only monetarily in terms of that's disincentivizing and discouraging hiring, but also from a risk perspective, because of course the government have now passed this workers' rights bill, which grants basically employees sort of carte blanche to do whatever they want on day one. So that means that in an environment where it's already more expensive to hire workers and businesses businesses are starting to think twice, they then have to think thrice, because actually once you hire someone, it's almost impossible to get rid of them if you don't like them, which further results in the pace of hiring slowing and vacancies rolling over and unemployment rising as a result. And then on the flip side of that, you've got the fact that the government has actually incentivized not working. You look at the various benefit uplifts that have come down the pipeline recently. Of course, the two-child benefit cap having been lifted in the budget, various other uplifts in welfare spending. So you get this kind of perfect storm where businesses across the UK are going, well, we can't afford to hire people because it's too expensive. And even if we could afford to hire people, it's too risky because once they're here, we can't get rid of them. And on the other side of the coin, you've got a lot of people out there going, well, actually, there's no point in me working. I can earn more by going on the dole or whatever you call it technically these days. So you've got this absolute, complete and utter mess of a policy mix. And the real issue with it is, and I think this is the point that we are now getting to, if not already at, is that once unemployment starts to rise, and it starts to rise in what we would call a non-linear fashion, basically going up very, very quickly, it becomes very hard to stop that rise in unemployment. And of course, as you rightly said, Ryan, we're now at 5.2% in terms of the unemployment rate in the 3 months to December. That's up from 4-ish% at the start of last year. The economy has lost jobs for 5 months in a row up to January, according to PAYE payrolls data. And while this does all argue for a much more dovish approach from the Bank of England, and I think it pretty much nails on a rate cut in March, providing the inflation data tomorrow behaves itself, I think we're also in a situation where actually it's debatable the degree to which those rate cuts would actually have any difference, because this is all being driven by what's coming out of Whitehall.
So I've said many, many times in the last recent years that I don't, in my opinion, monetary policy in terms of rate setting has never meant less, if that makes any sense. In fact, it's never had as little impact as it does now, because there's so many fiscal measures and so many other types of monetary policy out there other than just setting rates. To be honest, I'm not even a big believer in where you set the rates. Marking rates down 25 basis points has an impact on inflation even, because it's far more linked to supply chains, etc., etc. We're not the same. These aren't the same dynamics as 25 years ago when your interest rates did dictate inflation. I would love to see a study on it, and I'm assuming smarter people out there are doing studies on this.
I hope so.
But I really don't see how changing the base rates, 25 basis points here, 25 basis points there, really has any impact on inflation, let alone employment, let alone anything else. It just doesn't work. You need.
Well, I think certainly in an environment like this, where actually the two sort of policy levers are kind of pulling against each other, then the impact is even less. I mean, there's an argument that if you want to take it as extremes, you could put bank rate at 1%. Does it mean businesses are suddenly going to wear the cost of higher wages, or actually are they then going to be more likely to accept the risk of hiring? Or if you lower rates to 1%, are we suddenly going to get people off the dole? Of course, we're fucking not.
Well, right? This is what I mean, and I truly, honestly believe since the GFC, etc., when all these other new monetary policy tools were invented and the bazookas and whatnot, I really don't believe that where you set the rates has that greater kind of result on the underlying economy. Yes, it might free up some cash and whatnot to do things, but when you look at what capex is being spent these days, what fiscal policies are out there. When you look at the tariffs and the trade agreements and stuff, and the supply chains, etc., I think the individual base rate, yes, obviously it's important in terms of how mortgages are set and whatnot and stuff like that, and where your bonds are. But in terms of how it's impacting the underlying economy, I honestly think it's meant. I don't know how to frame this. I don't think it's ever meant less than it does now.
Yeah.
And one interesting thing I think as well is especially when you look at the UK employment data, if you strip out the government employment and the government wages, this is really, really bad. It's even worse. And part of me, the cynic in me, thinks that the only reason why the government is so happy to keep, bending over to unions and bending over and increasing pay on any demand,
props everything up a bit.
It's because it props up the underlying data. Because they need the underlying data to be propped up as much as possible. And a Labour government, we know, will bow to union pressures and whatnot. So, it actually ticks the boxes. So, unfortunately, I saw something a couple of days ago where It was on LBC actually. I think it might have been yesterday. So the train guards are looking to strike again because they're now having to scan e-tickets. Now, the union bosses are claiming that that's not one of the jobs they signed up for. Well, I'm sorry, but you're a train guard. Checking fucking tickets is part of your job. But they're saying, oh, checking tickets and scanning e-tickets are two completely different jobs, therefore they need more money. Now, the government will pay up. And the reason they'll pay up is because, one, they haven't got a backbone in them, but two, increasing that wage filters through into the national data, which makes them seem like they're doing a good job, but they're not. The taxpayers are paying for all of this, which is an increasing burden on us taxpayers. Just one other thing.
We've taken your muzzle off now.
Sorry. One other thing, a nice little stat for you. It's like only 1 in 4, apparently, or something like that. 1 in 4 university students that have studied like art and history and all these other made up courses are actually being able to find jobs at the moment. Whereas there's a 59,000 person shortage in plumbers and other tradespeople. Now that gives you a guide of like this dark path we've gone down where everyone's gone after an ism degree, no one can get a fucking job, and yet proper tradespeople are now commanding pound salaries because we're in need of them. And I think the whole landscape, and I don't think it's just UK either, I think structurally, I think it's all backwards at the moment. So yeah, good luck with that.
It is. It's not just the jobs market. To give you a little bit further depression, listeners, apologies for that in advance. I mean, inflation is coming down very, very rapidly indeed at this point, as we know. Probably going to get back to that 2% target by April. But you look at other indicators of the economy. Obviously, you've got the fiscal backdrop that we've mentioned. Yes, we boosted headroom in budget in November. A lot of that came through, let's call it what it is, accounting trickery in terms of backloading those tax hikes. Any new prime minister, new chancellor is going to run fiscal policy much, much looser anyway. So we've got big risks on that front. On the growth side of things, obviously, if the labour market's rolling over very rapidly, then it's tough to argue that the demand side of the economy is going to hold up. So you'd then be saying retail sales are going to start to face some stiff headwinds. You've also got, obviously, business investment, which fell very, very significantly indeed in the fourth quarter and just really has been going nowhere for a number of quarters now. There just isn't a lot of good news out there, if we're being completely honest with you. And I think what's most infuriating for me is two things. One is that certainly in terms of the labour market, this was very obvious. I think probably anyone with a brain could have told you, if you make it more expensive to hire people, you're going to get less jobs. That's just the way economics works. If something's more expensive, you generally get less of it, all else being equal. The second that I think is very, very frustrating is that actually solving a lot of these problems is quite straightforward as well, whether it be, propping up the labour market, whether it be restoring business confidence and spurring investment. None of this is rocket science.
So
there doesn't seem to be any will or desire or knowledge on Whitehall to actually get it done.
So I don't think it's out of the question now that we're going to see a U-turn on the national insurance employer contributions. I think we're going to, surely at this point, the Labour, the cabinet understand that they need to roll this back. There's been murmurs that they might, but I think going into this May election, I think they're going to have to do something. An interesting thing, and we've always said, me and you, for the last few months, it's better the devil you know in some instances, because the likes of like Rayner, Street in Burnham, who replaced, would be they're far more left than the current Labour government. However, Angela Rayner did say, a week ago, she did like an evening talk up north somewhere, and she came out very pro-business and kind of slating Rachel Reeves' anti-business takes a little bit. So, but again, fool me once, fool me twice. Maybe that's lip service, just making us feel like, maybe it is better for her. But yeah, we're in a bad place, basically. But and I keep saying this, hold on to a glimmer of hope. Politically, I still don't think we're in as bad a shape as French or the France and Germany.
That's all we've got to cling on to, but we will take anything we can get at this point. Right, with that all said and done, and with us suitably fired up, let's do the day ahead. Of course, probably the main event of the day is that US desks are going to be back after the long weekend. So you would expect liquidity to return to somewhat more normal levels, and also trading volumes to pick up as well. In terms of scheduled events, though, at 10 o'clock this morning, we get the latest ZEW surveys out of Germany. The expectations metric seen rising to 65.2 in February, up for a prior 59.6. I believe, although don't quote me on this one because I haven't actually checked it, I believe that the January ZEW survey was done pretty much at the time when Trump started throwing tariffs around about Greenland. So a decent chunk of that bounce will just be mechanical because obviously everyone was so depressed about that in January, but never mind. Into the afternoon session, we get inflation data from Canada. CPI sector held steady at 2.4% on a year-on-year basis in January. That would be unchanged from where we were in December. We also get Empire manufacturing figures from the New York Fed. That index expected at 6.2, down for a price 7.7. The Empire manufacturing in itself is never really a market mover, but for those who are unaware, that, and of course the Philadelphia Fed manufacturing numbers that we get on Thursday, they just help to shape expectations for the ISM manufacturing gauge that we get at the start of next month. Besides that, a few central bank speakers were due to hear from the Fed's Daly and Barr. They will both be talking on AI, which sounds like the most boring speeches imaginable. And on the earnings docket, the pace of corporate reports does slow a fair chunk this week, actually, although we are due to hear from Palo Alto Networks. They report after the market closed today. But for this morning, that is all from me.
And that's all from me. And today's show was sponsored by the word moist. And thank you to Clive Lambert for that. And whatever you do.
I thought I managed to sort of do that quite subtly, but apparently not.
Well, I definitely didn't. For those of you that don't know, Clive has now started challenging us to drop certain words into the show. So today's word was moist. Listeners, thank you for turning up as per usual. If you listen live, especially our US listeners that are listening very early, Tracy, Nick, etc. Love to you both. The rest of you, especially those of you listen to on the playback, hi from the past. And we'll see you all tomorrow. Keep it tight. Much love.